I'm Luke Ehinger, Director of Insurance Marketing at Valmark Financial Group. I'm here to talk to you about two relevant and invaluable planning ideas in light of recent regulatory and economic trends. The first is an opportunity to enhance your legacy plan. The Setting Every Community Up for Retirement Enhancement Act of 2019, better known as the SECURE Act, was approved by the Senate in December of 2019. The SECURE Act aims to increase access to tax-advantaged accounts and prevent older Americans from outliving their assets. So what's the problem? The problem is that in the process of raising revenue, the Stretch IRA provision was removed. Before 2019, children inheriting a retirement account could stretch out distributions over their longer lifetimes. This would effectively reduce the taxation faced by the inheritors and overall provide a much greater inheritance. Leaving your IRA to your children is no longer an effective estate planning solution. Post-SECURE Act, the funds are now depleted within 10 years. The accelerated distribution raises the inheritor's effective tax rate and dramatically increases the amount of overall tax paid. So what's the solution? Naming a charity as the beneficiary of your IRA results in no income taxes, an estate tax deduction, an enhanced legacy, and the charity receives the entire balance of your IRA. Since a charity will be receiving the entire IRA, your heirs will no longer have any benefit. However, a life insurance policy can replace or enhance the amount passed on to your heirs. Further, utilizing an IRA to pay for it can combine the benefits of both strategies. Let's look at an example. Mr. and Mrs. Smith own a $2 million traditional IRA. Their current standard of living is sustained by many other assets, and they are no longer in need of this retirement benefit. By taking systematic withdrawals or distributions from your IRA to fund a $4 million life insurance policy, they can provide a legacy to both their favorite charity and their children, while also significantly reducing the amount of taxes that are paid. If they do nothing, $2 million will be left to their children, but the government will take $800,000 of that, leaving only $1.2 million and zero to their favorite charity. By using distributions to purchase life insurance, $4 million is left to your children tax-free. Nearly all of the $2 million is left to their favorite charity, and only $32,500 goes to the government. By using distributions to purchase life insurance, $4 million is left to their children tax-free. Nearly all of the $2 million is left to their favorite charity, and only $32,500 goes to the government, which is the income tax due on that one distribution to pay a premium. Flash forward 20 years and your IRA has grown to $5.3 million. However, leaving the IRA to your children will result in $2.1 million going to the government and only $3.1 million going to your heirs. Again, your favorite charity has received nothing. Conversely, using life insurance, the same $4 million is left to your children tax-free, and more than $2.2 million is left to your favorite charity, with only $650,000 going to the government. Again, the income tax due on those distributions to pay premiums. All of this is done while protecting your access to your own IRA. If you ever need it, it's there. Even if you're not charitably inclined, this strategy makes a lot of sense and can help a lot of people. Moving on to the second planning idea, you may have heard about the Great Resignation over the past few months, and looking at the numbers, this trend is continuing in 2022. In a healthy economy, new hirings should outpace voluntary separations. Through April of this year, we've seen a steady climb in both hiring rates and resigning rates, suggesting a trend of employees leaving their current employers to pursue new opportunities. A majority of this increase is being seen in that mid-career workforce, those ages 30 to 45. Generally, you're more experienced technical workers. Outside of retail, which saw a skewed reaction to COVID-19, the biggest moving industries are tech and healthcare. Maybe not surprising. A large opportunity exists to capitalize on this trend. As a business owner client, you may be wondering what you can do to hang on to your top talent. An executive bonus plan, or a 162 bonus for short, can provide a perfect program for attracting, retaining, and rewarding key employees. As another retention strategy, adding a restriction to this arrangement can alleviate concerns of your employees moving on too early. A great tool for providing this benefit is a variable universal life insurance policy. Life insurance can provide tax-deferred growth inside the contract while also providing tax-free and non-reportable distributions in retirement years. On top of this, a tax-free death benefit for your employee's family, which is a powerful motivational tool. And these bonuses are not subject to any qualified plan limitations or reporting requirements. The addition of a long-term care rider would also provide additional coverage for your employee's family and help enhance that employer's chances of retaining the employee. Let's look at another example. A 40-year-old employee is set to receive $15,000 annual bonus. The employer has decided to cover all the tax due on this bonus, and the variable life insurance policy accumulates the cash value, tax deferred, which will be utilized for retirement distributions. In this case, $58,000 a year starting at age 65. As you can see, this can be a powerful tool for enhancing the retirement plan for your key employees. I hope you found these ideas interesting, practical, and useful as you think about your business and/or your own financial plan. If you have any questions or want to learn more, reach out to your financial advisor.